Can you take us through what the narrative is in your opinion, like right now for the Fed? This is probably one of the toughest situations that they've had to be in, navigating both Main Street and Wall Street at the same time. What does Fed Chair Jay Powell have to tell Congress?
Thanks, Don. Pleasure to be here. I think he's got three messages in the upcoming testimony. First, I think he reflects, as he did the last time, that indeed labor markets are still tight. I think he positions that as a positive. They're resilient, which means the ability to withstand further increases in rates. I think he'll also have to acknowledge that the disinflation process may be slower than perhaps he thought last month, with incoming data showing some stickiness in terms of inflation. So that's point one, the reality of the day. Point two, I think he's going to want to keep as much flexibility about the future of rate increases as possible. There's some talk now of a 50 basis point hike next meeting. Don't think that's baked in yet, but I think he wants to keep as much flexibility as possible to respond to incoming data and also to keep the market from getting too optimistic. And then the third thing I think he wants to do is just, again, reinforce the 2% inflation target. There's been some whispering that maybe there's some move there. I think he wants to be clear that 2% is where they're headed.
So, OK, if that's the case, we know the Fed is data dependent, and they've said it for so many weeks, months, years at this point now. There was an argument to be made, Roger, that the markets got off on a more bullish feel after the last jobs report, because there were signs that job growth was still there with not as much inflation on the wage front. How much is the Fed paying attention to the wage side of things per se, as opposed to the broader macro narrative of the number of jobs created in this country?
It's got to have an eye on both, obviously. But I think what they're worried about is the job market is the thing that's going to drive potential inflation in the area that's most prone to inflation right now, which is services. So it's nice to see just a little bit of cooling in the wages, but the job numbers have come in, very hot. I don't expect a repeat of the January, blockbuster number, but the most recent initial claims data also was on the hot side. And so I think they are continuing to focus on that jobs number, probably a touch more than the wage number, because they're worried about inflation picking up in the service sector, and importantly, inflation expectations, which have also been ratcheting up just a little bit of late. And so I think the focus should be on the labor market. That's where I think the risk is, and that is, I think, likely to be the number one topic.
The Fed hasn't had to face this kind of scrutiny from Main Street America, arguably in maybe a generation or two. Everybody now talks about it used to be gasoline prices last year. It was egg prices earlier this year. People are still very focused on the consumer side of things. How much does the Fed really have to kind of message itself in a different way, perhaps, a different form of communication, to make sure that Main Street America kind of gets what's going on right now?
Look, I think you've seen some of that already, because they're now talking about, the impact of inflation on the average Americans. They're talking about pocketbook issues to show that they are attuned to the fact that inflation is, a drag and a tax on low and moderate income Americans. So I think they're trying to put this notion of raising rates, slowing the economy, in a context that over time this is good for, the average Main Street person. And you've heard them say that many times. You've also heard them say it could be bumpy. So I think they're trying to get people ready for, a softish, hardish kind of landing, maybe a very mild recession. So I think they're very much trying to speak to Main Street as well as trying to manage expectations on Wall Street.
So, Roger, there's been, and one of the reasons why we have you on is because you've worn multiple hats on the private sector and the public side of things. You've seen the policy side from the Fed. You've seen the asset manager side of TIAA. I wonder, we've been talking a lot about the change in paradigm. It's gone from there is no alternative, right? We've got now higher interest rates to a point now where there are now reasonable alternatives. That's one of the acronyms out there. Is the Fed in a good spot? Are capital markets now more likely efficiently allocating capital because there are now legitimate risk-free rates? And what's the broader impact on corporate capital spending and the broader economy with interest rates this high?
Look, I think it's very important to get interest rates back to something that seems like historically normal rates. You know, the zero interest rate, and there is no alternative, really is not healthy, right? Money should not be free. There should be a yield curve that reflects the fact that, you know, borrowing money over longer periods of time becomes much more, you know, expensive. The Fed should not be trying to talk down the longer end of the yield curve. So I actually think we're in a healthier place where there are alternatives, where there's not an expectation that the riskiest assets is always where one should be, and getting back to some notion of fixed income investing as well as equity investing for the retail investor is important. I think it's also important for businesses to actually have, you know, a cost of capital that reflects the fact that they may be borrowing money for longer periods of time. And so overall, I think we're in a healthier place to not have zero interest rate policies and central banks trying to keep interest rates low across the entire yield curve to avoid anxieties around disinflation or even worse, deflation.